Right. Okay. Good morning, everyone. Uh, we are in the lessons of market structures. Market structures. Last day, I think we started doing monopoly market, and we completed up to a certain level characteristics, and we explained some characteristics. Okay. Right. We are in the process of completing market structures. I have already completed perfectly competitive market with past papers. It was very comprehensive discussion, very perfect discussion. And then last Wednesday I started monopoly market structure. Right. Dipna, any idea what is mean by monopoly market structure? What are the main characteristics? When uh, you know, hear this word, what comes to your mind instantly? Uh, Monopoly market.
Only one market.
Only one seller in the market, right? Only one seller in the market, right? And then we discuss what are the product is very unique because no close substitutes at all. Then what about barriers? There are barriers or no barriers?
There are barriers.
There are so many barriers to enter into the market, right? uh, it can be either artificial or natural barriers. Okay, so sorry, both artificial and natural barriers. Dipna, have you completed this part, price maker?
Yes, sir.
Okay, that's part done. Demand curve, marginal revenue, AR. I think no, right?
No, no, sir.
No. So that here it should be demand curve, MR curve, and MR curve of a not perfectly competitive market. Lama, it should be what? A firm in a monopoly market. Monopoly market, or you can say of monopolistic firm. Not perfectly competition market. Yeah, already completed perfectly competition market. Mistakenly that word has come here. Right. Right. Remember, I'm going to talk about demand curve, right? AR, AR mean average revenue, and marginal revenue of a monopolistic firm. Monopolistic. Right. This is the simple theory point. Remember, Amai, if firm is a price maker, sorry, let start from price taker. If firm is a price taker, demand curve or MR, AR, right? Demand curve, all are equal, and also put that it's parallel to the quantity axis. Can you remember the perfect competition market? In the perfect competition market, price, quantity, 0, demand curve demand curve is perfectly elastic, right? And marginal revenue, average revenue, okay, both are same, both are same in a perfectly firm, in a perfectly competitive firm, perfectly competitive, right? Simple way, Buddha, we can say if firm is a price taker, firm is a price taker, firm has perfectly elastic demand curve, or the demand curve which is parallel to the quantity axis. If firm is a price maker, if firm has a price making behavior, if firm is able to set its own price for the product, that is called price maker. If firm is a price maker, firm is a price maker, remember, firm's demand curve, firm's demand curve, firm's demand curve is downward slope in normal demand curve, downward slope in normal demand curve. Here, demand curve is parallel, or we can say perfectly elastic in the the price making behavior, right? If the firm can decide its own market, sorry, its own price for the product, that firm has normal downward slope in demand curve. Remember, I'm not talking about market demand curve, Lama, not the market demand curve. This, but in the monopoly, market demand curve and individual the firm's demand curve same. But here my point is, Lama, I'm explaining individual firms demand curve. Okay. So remember these two behaviors. If firm is a price taker, firm's demand curve is perfectly elastic. If firm is a price maker, firm is a price maker, firm is a price maker, remember, firm is a price maker, normal demand curve is a normal downward slope in demand curve. If firm is a price taker, or firm is in price taking behavior, demand curve is parallel to quantity axis, or this is called perfectly elastic demand. Are you okay with this, Dipna?
Yes, sir.
Okay. Then next point, Dipna, tell me, monopoly market, firm in a monopoly market, right? Firm in a monopoly market, this firm in a monopoly market act as a price maker or price taker?
Price maker.
Price maker, very good. Due to the significant market power, the firm can decide the price of the product. So, firm in a monopoly market is a price maker, very good. Then, if it is a price maker, how is the demand curve, Lamai? Monopoly is a price making firm. So remember, my demand curve, firm's demand curve should be downward slope in normal demand curve. This is the demand curve. One. Okay. Right. Normal demand curve. Right. Then put the here average and marginal revenue are not equal. Average and marginal revenue are not equal. Here remember, Lamai, average revenue is greater than, average revenue is greater than MR, marginal revenue. Both are downward slope in shape. I'll show you the shape of these curves with workings, no problem. So this is the normal theory point, right? Shall we read the first point? Demand curve, MR and AR curves of a perfect, so not perfectly competitive market, monopoly market. Right. Read it very carefully, Lamai. In a monopoly situation, there is no difference between firm and industry. Yes, 100% correct, Lama, because entire market is dominated by one firm. So firm supply becomes market supply, no any difference. Therefore, under the monopoly, firm's demand curve consists the industry's demand curve. Yes, that's correct. Since the demand curve of the consumer slopes downward from left to right, highlight the point, Lamai, monopolistic, right? Monopolist, the monopolist is mean one firm in the monopoly market faces highlight to the downward slope in demand curve. Downward slope in demand curve. Demand curve is normal downward slope in not the perfectly lasting. It means if the monopolist reduces the price of the product, demand of the product will increase and vice versa. Yes, you know this one, law of demand. AR curve of the monopolist slope downward from left to right. MR curve also falls and left to right and marginal curve above MR curve. The following no marginal curve is below AR curve. The following diagram shows the relationship between demand curve, MR and AR curve of the monopoly market. Right. Putha, write down this example and I want you to draw demand curve, MR curve and AR curve in the given space below. Right. Write down here. I'll use the write down the I'll use white sorry the whiteboard, that's better. Write down here page number 14. This is the table price quantity, total revenue, average revenue, and marginal revenue. Average revenue and margin. So that these are quantities: price 5, 10, 15, 20, 25, and 30. These are the prices given, right? Then quantity given, quantity 100, 80. You can see Putha, that normal, the law of demand, normal, the theory of law of demand operates here. When price increases, lamai quantity demand, falls 80, then 60, 40, 20, and 0. This is the quantity, right? Then I want you to complete, Putha, write down this table, page number 14. There's a table, but no values, right? Values have gone missing. So complete the table, and I want you to complete total revenue, average revenue, and marginal revenue. Okay, the lama. Now, how to calculate total revenue, Putha? Total revenue. Total revenue equals
Price into quantity.
very good. Price into quantity. Average revenue equals total revenue over quantity. Total revenue over quantity. Marginal revenue equals change in TR over change in. I'll give you 5 minutes to complete the uh, other columns for the TR, AR, and MR. Complete the table first, then you can draw MR, demand curve, and average revenue, AR curve. Are you done or need more time?
Done, sir.
Done.
Yes, sir.
Okay. Right. Good. Right. What are the values, Deepna? Here, total revenue, price into quantity, 5 into 100, 500. Here,
800.
800, 900, 800 again, 500, and 0. This is total revenue. Average revenue, how to calculate average revenue? Average revenue equals TR, total revenue over quantity, total revenue over quantity. Here total revenue 500, 500 into quantity, right? 500 into 500 over quantity. It means 500 over 100. It means answer is 5. Right? Answer is 5. Right? Answer is 5. Answer is 5. Here, how much, Lamai? At this point, total revenue 800, 800 over quantity. Quantity is 80. 800 over 80 means 10, right? 900 over 60 means 15 rupees. 15. 800 over 40 means 20. 500 over 20 means 25, right? Here, no value 0. Okay, Dalmai. Deepna, can you recognize another relationship, Buddha? Here you can see AR and price. Look at price column and AR column. What can you say, Buddha? Price column and AR column. Yes, Deepna. Price column and AR. Price. Look at price column. This is the price column. And AR, average revenue column. What is the relationship? Deepna? Yes, Buddha, hurry up.
It's equal.
They are equal. Remember, Buddha, every market structure, price and AR equal. Price of the product and AR equal, right? Then marginal revenue is calculated, change in total revenue divided by change in quantity. Change in quantity. Here, be careful, right? TR equals MR equals change in total revenue over change in quantity, right? Here, when moving from output 100 to 80, you can see change in quantity is 20, right? Here, change in quantity is 20. 100, now 80. Tell me, Deepna, when moving from 100 to 80, yes, output has, yes, change is 20. Is it positive change or negative change? 100, now 80. Positive or negative?
Negative.
Negative. So here minus 20. Quantity is minus 20. The reason is here change is minus 20 because quantity has decreased. What about total revenue? Change in total revenue 800, 500 and 800. What happens total revenue, Buddha? Has it increased or decreased when moving from 500 to 800?
Decrease.
Increase. So plus 300, plus 300. Okay. So here my plus 300 over minus 20 mean it should be minus 15. Here marginal revenue is minus 15, right? Marginal revenue should be placed in between two values, Lamai. Here marginal revenue should be how much? Minus 15. Marginal revenue should be minus 15. Then Buddha, calculate marginal revenue for other two outputs as well. Here, change in total revenue is 800, 900 mean 100 over change in quantity again minus 20 plus 100 over minus 20. How much the value? Dipna, how much the value? MR, marginal revenue, it should be plus 100 over minus 20. Hurry up, how much the value? Simple. Minus 100, plus 100 over minus 20. Dipna, are you there?
I didn't
Hello.
hear the question.
Huh?
I didn't hear the question.
I can't hear you. Are you not clear with MR?
I didn't hear the question.
Question is how much the value there? Second point, marginal revenue value. When moving from output 80 to 60,
-5.
-5. Very good. -5. Here marginal revenue is -5. Here lamai. Then you can see when moving from 60 to 40, output is increased. Yes, by 20 units. Total revenue falls. Sorry, output is also decreases. Output decreases -20. -20. Output decreases minus total revenue also falls. 900 now 800, then -100. -100 over -20 means it should be +5, right? Here marginal value should be +5, right? Here lamai -300, -300 divide by -20. Again, it should be +15. Answer should be +15. Okay, the here value is plus 50. Sorry, yeah, +15. Right here, value should be Buddha. How much? 500 change is 500. 500 over -20 mean 25, right? +25. Are you okay with these values, Deepna? MR, ER.
Yes, sir.
Okay. Then Buddha, I want you to draw these curves. Number one, demand curve by connecting these two. Then no need to draw TR. I want you to draw demand curve, uh, average revenue curve, and marginal revenue curve. Buddha, use the space given. There is a separate space below the table. You can use that space. There are two columns. You can use plus column to draw these three curves. Okay, the lama. But here there should be a minus sign because MR is minus. Price AR MR. Here quantity. Quantity changes 20 by 20, right? 20, 40, 60, 80, and 100. And 100. ARP, you can take it 5 by 5, 5, 10, 15, 20, and 25. Minus also, there's a minus side as well. -5, -10, -50. Okay, the Buddha. First, let's draw MR curve, Deepna, MR. Sorry, not MR, AR curve first. How to draw AR? AR at quantity 100, AR is +5. At quantity 100 here, quantity 100, MR, sorry, AR is 5 here. Second one, when MR, sorry, quantity is 60, AR is 10 rupees. When quantity is 60, AR is 15 here, right? When quantity is 40, look at the table. AR is 20 rupees. Okay, the Buddha. This is the AR curve shape of average revenue curve. This is average revenue curve, AR, average revenue curve. Buddha, remember, no need to draw demand curve separately. Both average revenue and demand curve are equal. If you draw demand curve, Buddha, demand curve will be the same shape, right? Same curve of AR, right? Then you can draw the MR curve as well, MR. MR, Buddha, be careful because look at first one. Buddha, have a look at the board, please. MR should be that value minus 15 should be marked in between 80 and 100, Buddha. Between 80, middle point, between 80 and 100, marginal revenue is minus 50. Look at the board. In between 80 and 100, 80 and 100 is mean middle point, 80 and 100, marginal revenue is minus 15. Minus 15 means this side, the minus side. Here is the point, right? Second one, what is second point? Marginal revenue is minus 5 in between 80 and 60. Simple. Marginal revenue is minus 5, in between 60 and 80, middle point here. Okay, the Lamai. Next one, plus 5 in between 60 and 40. Plus 5. In between 60 and 40, marginal revenue is plus 5 here. Right? I think and then between 20 and 40, marginal revenue should plus 50. Plus 50. Yeah. Okay, the Buddha. Then you can draw the, sorry, you can connect these points. This is the shape of marginal revenue curve. This is the marginal revenue curve. This is average revenue or demand curve. Let me know once you are done. The marginal revenue should be marked in between. මැද point එක තමයි ගන්න දැන් 86 100 උයි මැද තමයි -15 mark කරන්න ඕනේ. Clear? Let me know once you are done. Buddha, let me know once you are done, then we can move into the next part.
Done, sir.
Okay, right. Buddha, next to the diagram, you can see there's a space. Can you? Next to the diagram, there's a space. Can you see that?
Yes, sir.
Okay. Next to the diagram, write down. This is an explanation of diagram. Right. Write down. I think you're okay with what I'm explaining. Here, this is space for the graph. Table done. Table okay. Then graph. Graph also. Graph also done. Graph also done. Then next to the diagram, Buddha, here there are some few dotted lines. You can write down this note there. Write down. Both this is the shape, normal shape. Without data, Buddha, you should be able to draw this diagram. Quantity here, price, MRAR. Okay, the number. This is the shape of AR or demand curve. This is MR curve. Okay, the number. Now next to the diagram, write down both MR and AR. Both MR and AR. Both AR and MR. Both AR and MR are slope downward. Slope downward. Slope downward. Okay, Dalama, that's correct. Second point, you can see with the both MR and AR curves are downward sloping curves. Simple. Second one, MR is steeper. Marginal revenue is steeper. You can see with the MR is steeper than AR. MR is steeper than AR, or we can say with the demand curve, right? And there's another point, say something additional, but remember, if I were you, I would remember, right? MR cuts marginal revenue curve, marginal revenue, MR cuts quantity axis, Q axis, Q axis, quantity axis at half of, at the half at the half the distance of AR. Half the distance of AR. Right? At the half distance of AR. Now, what does it mean? Half the distance of AR. Right, write it down, then I'll explain. Right. It means, Dipna, this is the idea. Price, quantity. Assume Buddha, this is AR curve. If AR curve intersects, let's say at 120, right? AR curve intersects quantity axis at 120. If AR intersects quantity axis at 120, Buddha, remember MR curve intersects quantity axis by half of AR, half the distance of AR. Here the total distance 120, then MR curve will intersect quantity axis at 60, half the distance of AR, right? Then this is the shape of MR curve. Okay, these two distance are equal. Okay, the level. MR curve, this is MR, this is AR. MR curve intersects quantity axis at half of AR. You get what I said? Clear?
Yes, sir.
Okay, right. Done. Next point. What is next topic? Natural monopoly. Remember, Buddha, highlight. This is a really important point. I've seen some more questions in the past papers. Natural monopoly. I explained this part last day too. Natural monopoly. Simple idea is, Buddha, natural monopoly is this natural monopoly is a situation where the existing firm in the market, existing big firm in the market, in the monopoly market, is able to produce goods and services at lowest possible cost. Lowest possible cost. Because this firm produces goods and services for entire market, Buddha. Entire market. So their production capacity is too large. Right? We know that when production capacity is too large, firm is able to get the advantage of economies of scale. Economies of scale. Due to economies of scale, right? Natural monopoly means natural monopoly. Natural monopoly means, remember, natural monopoly means existing firm produces large production capacity, because this firm produces goods and monopoly, right? So this firm produces goods and services for entire market, so their production capacity is too much, or we can say too big. When production capacity is too big, too much, they can get the advantage of economies of scale. Economies of scale. Due to economies of the scale, Buddha, long run average total cost, LRATC, starts to decrease. Right? Simple idea, the existing firm in the monopoly market can produce goods and services at lowest possible cost. Lowest possible cost. This is called natural monopoly. This advantage restricts this lowest possible cost of existing firm, the lowest possible cost at which they can produce goods and services to the this advantage restricts other new firms come into the market, because other firms can enter into the market but they are not able to produce good same product at this cost. This is, I mean, as existing firm produces goods and services, right? They might come into the market but their production cost, average cost, will be higher than the average cost of existing firm. Did you get what I said? Okay, the Lama. So this is called natural monopoly, right? Natural monopoly. Remember, this advantage for only large scale firms, large scale firm in the monopoly market. I think got the point. Right. Write down Buddha, natural monopoly. Natural monopoly. If you want, write this down, right? Natural monopoly is all about economies of scale. Economies of scale. Right? Put a star mark and write down economies of scale. Write down, if one firm is able to, if one firm if one firm is able to supply, able to supply able to supply the total quantity requirement, total quantity requirement, total quantity requirement, total quantity requirement, total quantity requirement of the market, of the market, total quantity requirement of market, of the market, of the market at a lower price, at a lower price, a lower price, lower price than other firms, lower price than other firms, such a firm, such a firm becomes, such a firm becomes a natural monopoly, becomes a natural monopoly, becomes a natural natural monopoly. Remember, if one firm is able to supply the total quantity requirement, total quantity requirement of the market, this is the most important one, at a lower price. It means lower LRATC, LRATC, right? Lower price than other firms. Such firms becomes a natural monopoly. Remember, this advantage gained by the existing firm in the market due to economies of scale. Remember this word, economies of scale is a result of large scale production. Large scale production is possible here because the entire supply or the entire market supply is given by one single firm. Are you okay with this? Dipna?
Yes, sir.
Okay, right. Then put the examples right down, page number 15. Page number 15. Page number 15. Natural monopoly, okay. Natural monopoly, okay, done. Natural monopoly, not so definition done, no problem. Right, then Buddha, after that you can see since the given firm experiences economies of scale, I have given the reason as well. Right, since the given firm experiences economies of scale, when increase in production, such a firm can produce goods under sharply decrease in average cost. Therefore, the market has high tendency to naturally become a become a monopoly market. Right. Put that write down in these are Sri Lankan context examples. Sri Lankan context examples. Write down number one, Buddha, water supply. Water supply. These are monopolies. Water supply. They have created a natural monopoly. Natural monopoly due to the lower cost. Next one, electricity. Electricity. Right. Other one is Buddha, the infrastructure facilities. Infrastructure facilities. Infrastructure facilities. These are the examples for natural monopoly. Right. Then Lamai, last point of the monopoly market, limitation or drawbacks. Limitation or drawbacks of a monopoly market. Tipna, tell me, Buddha, is it, can we accept this market structure in economics, Buddha? Monopoly market, now you have learned all characteristics in monopoly market. You know, is it fair to have a monopoly market in economics? Is it fair or unfair? One single firm dominates the entire market. One single firm dominates the entire market, right? They have a, my God, massive market power, right? And they can charge any price from consumers. Consumers don't have close substitutes, right? Even though consumers are not willing to pay the price, consumers have to buy the product as consumers don't have options, right? And the barriers to entry, no perfect information for potential suppliers, potential investors, right? Price maker. Okay, the Lamai. What would you think, Buddha?
Unfair.
Huh?
Unfair.
Not fair, yes. So remember, Buddha, in economics, Buddha, we expect all markets to be perfectly competitive. We expect all market to be perfectly competitive. Remember, if market is perfectly competitive, Buddha, everything is good, especially from, I mean, consumers point of view, that's a, ideal, the best market structure, where, the no buyer, sorry, no seller, or no one single firm has the market power or has the capacity to influence the market, right? That finally, Buddha, that benefit goes to consumers. So in economics, Buddha, we expect all markets to be perfectly competitive, but unfortunately, reality, Buddha, we can't find the examples for perfect examples for perfect competition market. So monopoly, yeah, it's one of the market structures. We can't avoid that, right? In economics, Buddha, we can see it exceeds. So my point is, Buddha, limitation, right? We know that it's not good market structure. Now we are going to discuss what are the disadvantages, what are the limitations of having monopoly market, right? This is also really important. Write down, Buddha, there are 5 points. I'll use the white, the board, right? Other one, right? Write down limitations of monopoly market. Right. First one, write down limitations of monopoly market. First one, overall economic inefficiency. Overall economic inefficiency. Overall economic inefficiency in terms of in terms of production and allocative inefficiency. Allocative inefficiency. Allocative inefficiency due to the lack of competition. Due to the lack of competition. Due to the lack of competition. Lack of competition. Economic inefficiency. Economic inefficiency in terms of both production and allocative. Can you remember the economic efficiency consists of two parts, productive efficiency and allocative efficiency? I want definitions for that. I don't expect perfect definitions, right? As you know, or as you can remember, please give me a brief introduction to the brief definition for productive efficiency and allocative efficiency. Unit number 1. Yes. There are two parts of economic efficiency. First one, productive efficiency. Productive efficiency. Dipna, the simple idea of productive efficiency is producing goods and services at lowest possible cost, with minimum wastage, right? Productive efficiency means what? Producing goods, producing goods at the lowest possible, lowest at the lowest cost. That is called productive efficiency. Deepna, what is mean by allocative efficiency? Yes, Buddha? We've discussed this part in detail. Efficiency. Allocative efficiency. Allocative efficiency. Yes.
Allocating resources.
Yes. Okay. Allocating resources for what? Allocative efficiency. Allocating resources, especially scarce resources, to produce goods and services which are wanted by the society, which are demanded or which are preferred by the society. To achieve this allocative efficiency, Buddha, there is a condition. Can you remember condition? At least, what is the condition for allocative efficiency? Marginal cost equals price of the product. Marginal cost equals price of the product. This is the condition. Okay. If firm charges a price which equals marginal cost, I'll repeat. If a firm charges a price which equals marginal cost of the product, allocative efficiency is achieved. You know, marginal cost is the cost. The marginal cost is the cost. Marginal cost is the cost. Which is added to the total cost when we increase the output by 1 unit. That's called marginal cost. Okay, this is the condition for allocative efficiency. But when it comes to monopoly market, remember, this firm has a significant market power. No competitors, significant market power. So remember, Buddha, monopoly market, that monopolistic firms charges a higher price, or the price which is higher than marginal cost. If marginal cost is 100 rupees, Buddha, for the allocative efficiency, we expect firm to charge only 100 rupees, right? If marginal cost is 100, Buddha, the price also should be 100 to achieve allocative efficiency. But in monopoly firm, Lamai, they have a significant market power, so they never charge price which is equal marginal cost. They charge a higher price. If marginal cost is 100 rupees, Buddha, they can charge might be 200 rupees. In the monopoly market, marginal cost and price of the product are not equal. Normally, price of the product is greater than 2-3 times greater than marginal cost due to the lack of competition. Due to the significant market power, they charge a higher price than marginal cost of the product. Right? Uh, if marginal cost is 100 rupees, marginal cost is the cost of producing additional unit. How much cost added to the total cost when we increase output by 1 unit, right? That is called marginal cost. To achieve allocative efficiency, Buddha, marginal cost should be equal marginal cost should be equal price of the product. But in a monopoly market, due to the high market power, right, the massive market power, they charge a higher price than marginal cost. Then tell me, Buddha, is marginal cost uh, equal price of the product or not equal? Are marginal cost and price of the product are equal or not now in the monopoly market? Hurry up, Pudha, tell me. Are they equal or not?
Unequal.
Non-equal. So this is called, if they are not equal, Buddha, that is not allocative efficiency. That is allocative inefficiency. That's why we say in the monopoly market, Buddha, allocative efficiency is not at all, right? Here, allocative inefficiency is there. Allocative inefficiency. Allocative inefficiency. What about productive efficiency? Is it available or not available? Is perfect, sorry, monopolistic firm efficient in terms of production efficiency?
Yes.
To achieve, yes, I'll answer. Okay. To achieve this, Buddha, remember the firm should be able to, I mean, firm should produce goods and services at lowest possible cost. Buddha, this one also is not achieved in the monopoly market. I appreciate your answer. The reason is, remember, uh, to produce goods and services at lowest possible cost, they don't have any competition, they don't have any enthusiasm or no any pressure, right? In the perfectly competitive market, Pudha, firm has the huge threat, huge challenge, uh, because there are so many firms in the market, so many competitors in the market, right? And also price taker. So they have to produce goods and services at lowest possible cost to compete with other firms. But in the monopoly market, Pudha, the existing monopolistic firm does not have any enthusiasm or encourage to produce goods and services at lowest possible cost. Why? No competition. Whatever, I mean, at whatever price they, sorry, the cost they produce goods and services, the consumers have to buy it. No problem. Consumers don't have option. So remember, Buddha, to achieve productive efficiency, market should be perfectly competitive, right? Market. Assume, Buddha, in Sri Lanka, there's only one garment factory, right? Fresh milk factory, Ambevela or someone. Let's just imagine. Only one, no other competitors in the market. Then, Buddha, if only Ambevela was in the market, in the fresh milk industry, Ambevela, right, did not have any enthusiasm, any motivation to produce goods or fresh milk at lowest possible cost. Why? Ambevela knows that no competitors in the market, no problem, right? No problem with cost. Why should I try to reduce the cost? Why should I try to be efficient? Why? No problem, because no competitors in the market. I can produce goods and services at whatever cost, no problem. So remember, in the monopoly market, allocative efficiency also is not achieved due to lack of competition, or we can say lack of yes, competition. Firms are not motivated. Firms are not encouraged to produce goods and services at lowest possible cost due to lack of competition or no competitors in the market. Did you get my point? Yes.
Yes, sir.
Yes. Right. So remember, in the monopoly market, Buddha, we can't see allocative efficiency. It's allocative inefficient. Allocative. Can you write this down? Allocative inefficient. Allocative inefficient. Sorry, not allocative. Productive inefficient. Productive inefficiency. Productive inefficiency. They don't have any motivation, right? They don't have any challenge, right? That they want to produce goods and services at lowest possible cost. So in the monopoly market, Buddha, no productive efficiency and or allocative efficiency. None of them. The main reason, Buddha, we can say no competition. If there is a no competition, firms don't want to be productively efficient, right? There's no requirement to produce goods and services at lowest possible cost. When it comes to allocative efficiency, Lamai, allocative efficiency also not there because they charge, you know, they try to charge a higher price than marginal cost of the product because they have a market. Done, Buddha? Need more time or shall we move on? Dipna, shall we move on?
And sir.
Done. Okay, right. Second, Buddha, you can you could have written this in a separate note or separate a sticky note or something, right? Couldn't tell that. Second one, Buddha. Second main limitation of monopoly market is write down. First one, okay, right? I've explained that. Second one, write down consumer exploitation. Consumer consumer exploitation. Now, what is mean by consumer exploitation? Hmm? Consumer exploitation. This means that they charge, I mean, firms tends to charge a higher price from consumers as consumers don't have options, right? That is called consumer exploitation. Okay, the lamai. Write down consumer consumers are subject to consumers are subject to consumers are subject to a price which is excess of marginal cost. Excess of marginal cost. Excess of margins. Here, simple idea, Buddha. The consumers are given higher prices. That is called consumer exploitation. Higher prices with no choice. Okay, the Laman. Consumer exploitation. Firm is able to exploit the consumer, right? It's mean creating unnecessary pressure in terms of price and also choices. Okay, that is called consumer exploitation. In the perfectly competitive market, no exploitation. Firms can't charge a different prices for them, right? They have to charge the same price as other firms charge, right? Okay. Third one, third point, write down limited motivation. Limited motivation. Limited motivation. motivation to improve to improve quality of output, quality of product or output. Best example Buddha, Sri Lankan railway. Whatever happens, right, whatever criticisms is there, they don't have any enthusiasm or any requirement, any necessity, right, no any motivation to upgrade the service they provide. The reason is that they know that no competitors in the market, right? Whatever we provide, whatever we give to the consumers, Buddha, they have to buy it, right? So motivation limited motivation to improve quality of the product. If there is a huge competition, Buddha, they have to upgrade the product due to otherwise, Buddha, the consumers will jump into other products, right? Okay, the lamai. Limit. Oh, sorry, motivation. I'm sorry. Motivation to improve quality of the product. Fourth one, lamai. Fourth one, write down. Price discrimination. This is also possible in. I'll explain this point, right? Price discrimination. Discrimination. Price discrimination. Buddha, I'll explain this point in detail in Wednesday's class, right? Theory class, right? Fourth one, write down. Sorry, fifth one, last one. Limited or no incentive. Limited or no incentive. Limited or no incentive to practice. To practice product and process innovation. Product and process innovation. Process innovation. Innovation. Simple idea, Buddha. They don't want to be innovative, right? They never think of quality products, or we can say innovative products, something new, right? We need to, offering something new to consumers, quality products to consumers, right? They never think of that. The reason, Buddha, no competition. They know that why should I, right? The firm thinks, why should I spend more money on research and development, because for the innovation and new products come through this research and development, right? Firms have to invest on research and development to find something new. Then for that, this firm, monopolistic firm, thinks, why should I allocate more funds, why should I spend more money on research and development to find something new? Why should I offer something new to consumers? Because whatever I offer, consumers have to buy. That mentality, that attitude is there, right? So limited or no incentive to practice product and process innovations. Okay, the Lamai, due to lack of competition, right? So due to these limitations, we say monopoly market has several limitations, Lamai, right? From economic point of view, we can't accept this market structure. Can't accept this market structure, right? Are you okay with this?
Yes, sir.
Yes. Okay. Then Buddha, last part. This is done, Buddha. This is completely done. I'll explain. I need to make a small note on price discrimination, fourth disadvantage or limitation of monopoly market. I'll do it on Wednesday. Before I wind up the class, Buddha, we can complete the table in page number 50. Right? Compare the perfect competitive market and monopoly market structure. Right? Okay, limitations done, no problem. Then Buddha, I want you to compare monopoly market structure and perfectly competitive market structure. Buddha, when you compare, right? Compare, start from basic four main dimensions: number of sellers, uh, nature of the product, barriers to entry and exit, and information. Right? Use these four first, then you can jump into other characteristics. Right? Shall we? Shall we do this? What are the market structures given? Perfectly competitive. First market structure that we have completed. Perfectly competitive. Perfectly competitive. Second one, monopoly. Monopoly. Right. Okay, Buddha. First one, here the character. Right. Start from first one, Buddha. What is first one? The number of sellers. Number of sellers. Number of sellers. Dipna, can you tell me, Buddha, in perfectly competitive market, what about sellers?
More sellers.
More sellers, or we can say large number of sellers. Large number of sellers. Number of sellers. Monopoly, simple.
Single seller.
One, yes. Right, first one done. Second one, nature of the product. What kind of product they are selling. Okay, nature of the product. Nature of the product. Tell me about the nature of the product. Perfectly competitive market. What's the nature of the product? Nature of the product.
Identical.
Identical or homogeneous. Yes. Identical. Monopoly market. It is unique, Buddha. Unique. Unique. No close substitutes. Right. Third one. Third one. Barriers to entry. Barriers to entry. Perfectly competition. Ipna.
Limited barriers.
No, no, perfectly competitive. No barriers. No barriers. No barriers. Any firm can enter into the market anytime. No barriers. Right? No barriers. Monopoly.
Have.
Huh?
There are barriers.
There are so many strong and effective barriers. Yes. You can say barriers. More, I mean, strong and effective barriers there. Perfectly competitive market, no barriers, no legal, no nothing. Right? Right. Fourth one, information, nature of information. Uday, you can do it in detail, right? I don't have enough space and you can do it, right? Information. What can you say? Information. Yes. Perfectly competitive market. Are informations perfect or imperfect?
Perfect.
Perfect information there. Perfect. Monopoly market, imperfect. Imperfect. Right. Fifth one. Then Buddha, main four characteristics are done, completed. Then you can jump into other characteristics. Fifth one. You can talk about price taker or making behavior. Buddha, firm in the monopoly, sorry, perfectly competitive market, price maker or price taker?
Price taker.
Price taker. In the monopoly market, Buddha, it's price maker. Price maker. What about advertisement? Yes.
Advertisements.
Price taker or maker. So the advertisement in the perfectly competitive market,
No
no
advertisements.
advertisement. Monopoly market, monopoly market, the no advertisement. Have you ever seen, electricity board, railway department making advertisement? No, they don't want to do. They don't want to spend money on advertisement because no competitors. Why do they, spend money on advertisement? No, it's a similarity between perfectly competitive market and monopoly. That's not difference. Perfectly competitive, no advertisement due to homogeneous product. Monopoly market Buddha, no advertisement due to single firm in the market. So no need advertisement. Right. Then Buddha, sixth one, you can say the behavior of AR and MR. AR and MR. AR and MR. In the perfectly competitive market, AR and MR equal. Here, Buddha, AR, MR not equal. AR is greater than MR. Then you can say something about firm's demand curve. Firm's demand curve. Firm's demand curve. In the perfectly competitive market, perfectly elastic. Perfectly elastic. This shape, can you remember? Perfectly elastic. In the monopoly market, Buddha, demand curve is normal downward slope in demand. Downward slope. Downward slope in demand. Are you okay with this?
Yes, sir.
Okay. Then Lamai, last one, you can say something about long run profit. I'll explain this. I explained this in Wednesday class, last day. Uh, long run profit. Firm in the perfectly competitive firm earns normal profit in the long run. Right? You can say something about normal profit. Sorry, long run profit. Last one, 8. Long run profit. Long run profit. Perfectly competitive firm earns normal profit. due to no barriers to entry. In the long run, so many firms come into the market, then the entire profit level is distributed among so many sellers, result in small or very small amount of profit to one firm. That is called normal profit. Monopoly, supernormal profit. Supernormal means simple idea, very large amount of profit. Supernormal profit. Normal, supernormal. Are you okay with this? Done or need more time?
Answer.
Okay. Right. These are the differences between perfectly competitive and monopoly market. So that remember, when make a table, showing this differences between any market structure, remember to start from plus 4 characteristics. Those are main characteristics. Then you can jump into other, this price maker, price taker, right, demand curve, MRAR, right. These are second, right. This other characteristics come under main dimensions of market structures, right. Okay. Yeah, that's enough today. See you next day. Thank you for coming. I'll be starting third market structure on Wednesday. Okay, Buddha, thank you for coming. See you next day. Bye.
Thank you, sir. Goodbye.
Bye.
Recording